Hello everyone, my name is Jordan Griffin and welcome to my channel. Today I'm going to be talking to you about a 401k in the year of 2021. Just give a little bit of background. I am a 401k plan administrator for the company that I work for. I've been doing that for about 4 or 5 years now, and just wanted to tell you, by investing just 10% of your salary each year into a 401k, you can retire a millionaire. I'll also be going over some of the pros and cons of a 401k versus other investing vehicles. Hopefully, if you're starting a new job and maybe you're now eligible to contribute to your company's 401k. Now, most of the time, there's some type of, probationary period that you're going to have to go through before you're eligible to contribute. So for my company, you have to be, I believe, over the age of 21 and have at least a year of service with the company before you're eligible to start contributing to the company plan. So what is a 401k? It's an investment vehicle, much like a Roth IRA or even just like a brokerage account. It's just an option for you to contribute some of your money and have it work for you in the stock market. Now, there are a couple different ways that you can contribute to a 401k. There are traditional contributions and there are Roth contributions. So essentially, with those two, you're choosing to either pay your taxes now or you're choosing to pay them later. So if you go with the Roth option, you're paying the taxes now so that when you pull your money out in retirement, you're able to pull it out tax-free. For this year of 2021, the maximum contributions allowed for a 401k are $19,500. If you're over the age of 50, however, there is something called a catch-up mechanic, which allows you to contribute, I believe, an extra $5,500 on top of that $19,500 for a total of $25,000. Now, let's say you just started a brand new job and you started investing in your 401k at age 22 with $8,000 a year. Now, if you max your contributions each year after that until you're retired through the wonderful power of compound interest, you should have roughly over $3 million in your 401k by the time you retire. Now, I realize that the odds of somebody being in their early 20s making that kind of money where they can contribute $19,500 a year to their 401k is pretty low. So either if you do want to do that, you have to decide to just drastically cut all your other expenses so that you can contribute that maximum amount, or just contribute a lower amount, say 10% of your income to your retirement. So I started contributing around the age of 26. I'm 31 now. And since 26, my account is now roughly about $67,000. And I've been contributing about 10% of my income each year, which I do receive a company match of about 4% on top of that. So essentially, I'm contributing 14% of my yearly income towards my 401k. Now I'm going to go over a few of the pros of a 401k. Starting out is just the power of compound interest. So if you're young, early 20s, even 30s, you have so many years of compound interest to work for you. Let's say conservatively, the stock market returns 4% annually. That's very conservative. I mean, if you've got 10% of your income going to your 401k each year, it's growing 4% each year. By the time you're 60, there's no doubt in my mind that you'll have over $1 million in your account. Another great option here is that the contribution limits are very high, as opposed to a Roth IRA in which you're limited, I believe this year, to $6,000. In a 401k, you can contribute that $19,500, which if you're able to, no, don't wipe your nose while you're talking. Another benefit of a 401k is if your company offers what's called a safe harbor match. Now, what this allows for is your company to contribute money on your behalf to your 401k. A typical scenario you'll see in companies are they'll match 100% up to 3%, and then they will match 50% at 4 and 5. So that's what my company does. So if I put in 6%, the max the company will match is 4%. So previously I was contributing 10% and the company was matching 4%, so I was up to 14%. This year I decided to switch it up and just do 6% of my income so that I get that company match and then really nothing beyond that, while still contributing to a Roth IRA and a brokerage account. Another benefit of a 401k is that due to the fact that it is a qualified retirement plan, it is typically protected from creditors due to the ERISA Act of 1974. Some instances where you're not going to be protected in that situation would be if you have a spouse that you have divorced, they would be able to access those funds. Or if you owe a bunch of money to the IRS, they would be able to garnish some of those funds from your 401k. A benefit of it is if you do owe money to like a credit card company or you plan to declare bankruptcy, typically those funds are going to be inaccessible by those creditors. Now, what are some of the cons of a 401k plan? Well, to start, account fees can be pretty high, as much as 2% in some instances. I know in the last year or 18 months, my company, we made the decision to switch to another plan provider with some lower fees. So by lowering the fees, not only was the company able to save money, but each of the individual plan participants also save money on those management fees. Another con is going to be the funds are kind of inaccessible. I mean, these are really long-term focused funds. If you need your cash quickly, you're going to want to focus more on a brokerage account or a high yield interest savings account. But you are able to access the funds before retirement, which in terms of a 401k, they consider to be 59 and a half years old. But you will pay a 10% penalty on those funds. Now, I believe this year there was some new laws put into place in the CARES Act, where if you were facing some hardships, there was a way to, I believe, not have to pay that 10% fee if you could claim that you were impacted disproportionately by everything going on in 2020. One thing that can definitely be an issue with a 401k as well is there's going to be a limited offering of funds. This will depend on your plan that your employer has participated in. I think ours, we have a significant amount of funds, so it doesn't really feel much different than just investing in some mutual funds or ETFs in a brokerage account, which is nice. But that's just something to watch out for if you want a little more diversity in your portfolio. Or hey, maybe you like the simplicity and the fewer funds, the better. Now, if you're like me and you're of the millennial generation, odds are you're probably going to be job humping. Yes, job humping a lot. Obviously, job hopping is what I meant to say. Okay, so you're going to be job hopping a lot. So in a 401k, a lot of times it's a vesting plan. So typically you vest about 20% per year, meaning that if you leave and you're only 60% vested, the funds that your employer matched, you'll only be able to take 60% of them out when you leave or you transfer your 401k to a new plan with a different employer. Now, companies do this typically to, entice employees to stick around and not job hop like many millennials have. Now, at the end of the day, guys, this is a great investment tool if your company offers a match. If they don't, I'd probably recommend going more with a Roth IRA or even just like a basic brokerage account. There are more options out there if your company doesn't offer that match. Because in my mind, the company match is essentially free money. I'm doing nothing and I'm getting 4% of my income, which is fantastic. So that's the end of the video. If you guys liked it, you can comment down below and remember to subscribe. It really helps out the channel. Thanks.